We're diving straight into an analysis report titled, Can SQQQ Hit $80 Again? My 2026 Forecast.
Right. It uses a mix of math and narrative triggers to project a pretty significant move in the leveraged ETF.
And as I see it, the core argument is that hitting the $80 target for SQQQ, well, it only requires a pretty standard 5.7% drop in the NASDAQ 100.
Which, mathematically, is very clear. It seems straightforward.
It is, and that clarity is a great foundation. But, we have to immediately address the structural reality of holding leveraged products over this kind of time frame.
Yeah, that's where I have a question. I wonder if we've really captured the gravity of that structural drag. The one inherent to SQQQ.
Especially when assessing the moderate high probability they've assigned here.
Exactly. When you introduce a long-term forecast like this, you're automatically bringing in systemic risks that aren't just, isolated events.
And that is precisely where we're going to start our critique. The analysis of the $80 target needs to more robustly integrate the practical constraints of holding a leveraged ETF, like volatility decay.
Especially given the time frame, extending out to 2026.
So the weakness here is that the report, it does accurately identify volatility decay as a risk. It's in there.
Right, but it's isolated. The discussion is just sort of cordoned off in the final risk section.
And by doing that, it fundamentally fails to factor that constraint into the initial probability assessment.
Or, and this is crucial, into the necessary timing for the market move.
That isolation is a critical distinction. Predicting a catalyst in, Q1 or Q2 of 2026? That implies a potential holding period that could be 6, 12, maybe even 18 months.
Depends on the entry point, sure.
And over that long of a timeline, the systematic erosion from daily compounding, that volatility decay becomes the single biggest enemy of the thesis.
Exactly. If the NASDAQ just grinds sideways or, sees slow, choppy movements before that 2026 catalyst finally hits, that decay could easily negate half, maybe even more, of the required 5.7% decline before the real move even starts.
So you can't assess a moderate high probability for $80 based only on a static price drop. Not when the product itself is systematically designed to lose value over time.
So the probability isn't just about the likelihood of the NASDAQ dropping.
No, it's about the likelihood of it dropping fast enough to overcome the decay.
It's a fundamentally different model, and the analysis needs to reflect that. It's a dynamic constraint.
Okay, so our suggestion for improvement is to strengthen the analysis. And to do that, you have to explicitly link the expected timing of those 2026 catalysts.
The AI fatigue, the soft landing failure.
Right. Link them directly to the decay mechanism. The material should actually model the necessary pace of the NASDAQ 100 drop that's required to counteract the daily decay.
Over that predicted holding period up to 2026?
Yes. And this transforms the whole thing from a static price target review into a dynamic timing analysis. It's what any professional would expect for these products.
I see what you're going for.
Let's give some really actionable examples here. I'd recommend reframing that current support level of 6340.
Okay.
Don't just call it a technical floor. Call it the decay threshold.
I like that framing. It gives a time-based trigger for risk management.
For instance, the analysis could say something like, if the NASDAQ trades flat, SQQQ hitting 6340 by, say, June 2025.
Confirms that the decay is currently overwhelming the technical floor.
And therefore, compromising the 2026 forecast's viability.
That's a measurable, proactive constraint. I like that a lot.
In building on that, to really reinforce this dynamic nature, we should introduce a calculation.
Okay.
Something detailing the minimum average daily downward momentum that's needed in the NASDAQ 100 from now until Q1 2026.
Ah, so that figure lets you gauge the required velocity. You'd have a clear metric to see if the 5.7% drop is even achievable, net of decay.
Precisely. It shifts the focus from, will the market correct, to the much more important question for this instrument.
How fast must the correction occur to maintain the $80 target?
That's a powerful refinement. It forces the mathematical model to align with the realities of the instrument itself. It moves way beyond just a basic risk acknowledgement.
It does. Okay, let's shift gears. The second critique, this one touches on the core narrative significance of the whole forecast.
Right. So what I really like about this report is the depth of the narrative they've developed.
This bear case?
The one relying on the capital economics forecast. It is. From massive systemic crash fueled by AI capex fatigue. It's ambitious, it's well-researched, it's really compelling stuff.
It is. But that powerful narrative, it actually creates a structural problem with the central focus of the analysis report itself.
How so?
The focus on the $80 price point lacks structural significance because that deep bear case narrative you mentioned, the AI bubble burst. It supports a vastly more dramatic outcome. So there's this disconnect between the report's central target and its own core thesis.
Ah, I see the tension. The report meticulously proves that $80 is relatively easy to achieve.
Right. It only needs, like you said, a run-of-the-mill market correction, 5.7%.
Yet the main structural catalyst they build up is this AI bubble bursting, a scenario where the NASDAQ drops 20, maybe 30%.
Which would catapult QQQ to $120 or even higher.
So it creates an almost, an ironic effect by proving $80 is possible without even needing the main thesis.
The analysis unintentionally undersells the power and relevance of that high-stakes crash forecast.
The reader is left wondering, why are we spending so much energy on $80 when the key risk outlined is so much bigger and, frankly, so much more interesting?
It really does feel like aiming for a single when you've just proven you have the power for a grand slam.
Right. It's a matter of calibrating the target's ambition to match the narrative's ambition. So our suggestion for improvement
is to reframe that $80 target.
Exactly. It's not the ultimate forecast. It's the critical technical confirmation point.
Or maybe the first major resistance test that validates the whole shift in market sentiment that's needed for the bigger move.
The report should center the discussion on that high-stakes potential, the 120 plus, while using $80 as the immediate actionable proof point for the shift.
So you maintain the mathematical precision of the $80 level.
But you give it far greater strategic importance within the broader forecast.
That's how you get structural harmony. We need to define two distinct phases.
Okay, for concrete examples, the analysis should be structured to clearly define phase 1. Let's call it correction.
And that's the movement to $80. It just confirms short-term pullback risks, the 5.7% drop.
And then you have the high-stakes phase 2, the crash. Fact.
We label it the threshold of narrative validation.
I like that. Crossing that point shifts the probability away from just soft landing fatigue
and toward the full, dramatic AI bubble burst scenario.
That elevation makes the $80 mark profoundly more meaningful. It ensures the target structure actually matches the ambition of the narrative.
Yeah. The reader who buys into that deep bear case needs to know where the confirmation is. $80 should be that marker, not the finish line.
Okay, let's move on to our final major opportunity. This one centers entirely on immediate clarity.
And foundational context for the current price levels.
Right. This ties back to respecting the reader's expertise. The argument is that the core technical context is buried.
How so?
To maintain clarity and immediately establish the correct foundational context for the current price, the critical note about the 1-for-5 reverse split needs to be moved way, way earlier in the material.
Okay, so the weakness is that this crucial detail that SQQQ underwent a 1-for-5 reverse split effective November 20, 2025 is buried.
Deep in Section 3, Technical Analysis and Important Context.
And that detail is essential. It fundamentally changes how someone interprets the current price, which is around $68, relative to the historical charts.
And relative to the report's use of the term all-time lows, any experienced trader looking at a long-term SQQQ chart will be immediately confused if they don't see that context up front.
They'll wonder why historical prices, which were often in the low teens, are suddenly being discussed in the high $60 range.
It just risks the reader misinterpreting the report's entire baseline assumption. And, while the material makes the sophisticated point that the split aids institutional hedging interest,
which is an excellent insight.
It is, but that insight doesn't help if the reader is stalled just trying to reconcile the price itself.
So the suggestion is really critical for establishing trust and baseline understanding.
Yes, elevate the reverse split detail. Put it in the executive summary or right after the introduction of the current price in Section 1.
You have to ensure the reader understands the current price level is post-adjustment.
And that the all-time lows being discussed are technically recent post-split lows.
That immediate clarity is just non-negotiable for a document like this. It has to be where the reader first encounters the price.
So for a concrete example, we should just implement a specific bullet point in the executive summary.
Something sharp and impossible to miss.
Exactly. Critical context. All figures reflect prices post 1-for-5 reverse split, November 20, 2025. Simple.
And then integrate that context directly into the first line of Section 1, where the math actually begins.
For example, current price, around $68.41, and then in parentheses.
This price reflects the 1.5 reverse split effective November 20, 2025, clarifying the adjusted all-time lows relative to the split.
These strategic placements, they ensure the foundation of the analysis is just rock solid. The critical context is provided immediately.
And that allows the reader to dive into the math and the narrative without any distraction or confusion.
It lets the more complex discussion of decay and target validation proceed smoothly.
Right, it's about building the analysis layer by layer. You start with the unambiguous facts before you move into the probabilistic forecasts. It ensures the structural integrity of the entire report.
So this analysis report is fundamentally strong. It proves the mathematical simplicity of reaching $80 and provides two really compelling narratives for 2026.
Especially that high-stakes AI bubble burst scenario. It just needs some strategic refinement to maximize its impact.
To maximize the impact of this work, the focus should be on creating greater structural harmony. We suggest integrating the volatility decay constraints right into the probability assessment,
which is crucial for leveraged products. Define the pace of the required NASDAQ drop, turning a static risk into a dynamic, time-based constraint.
Second, redefine the role of that $80 target so it serves as a milestone, one that validates the far more compelling 120-plus crash narrative,
transforming it from a mere forecast to a critical threshold of narrative validation. It confirms the larger thesis is in play.
And finally, ensure the critical 1-for-5 reverse split information is moved to the very front of the analysis.